Welcome to Subramani. This video is one of the very many videos which I keep making, saying how to become a good investor or how to become a better investor. You already are a good investor, how to become a better investor, or rather in my life what helped me become a good investor. So step number one, which some of you, my viewers, some of the viewers may not agree, is to find a good investment buddy, right? Some of us are very disciplined, we don't need an investment buddy. So whether it's even in the gym, right, they tell you find a buddy who will ask you kal kya hua, why didn't you come. It's very difficult for your coach to ask you that because your coach is much younger, he's intimidated by you, you're paying him a lot of money every month, so he does not want to ask you such questions, but he's he's a little embarrassed asking you. But if you find a buddy, somebody who also comes to the same gym at the same time and is willing to talk to you, he'll say kya ghum rahe the kya, where were you roaming, why didn't you come. So that kind of nudge, a friend, all that is very useful to have an investment buddy. And I think in my life that person is very important. He also turned out to be my investment advisor, investment broker, and that relationship is now 44 years of 43 years, 1979 till today. It's 43 years of relationship. It's worked fabulously. So the most important thing is both of us lived for those 43 years, because if one of us were dead, then this relationship couldn't have continued. So looking after your health, finding this buddy, and I was lucky to find this buddy pretty early. I was in class 12 and he was 4 or 5 years my senior, and that relationship still continues, which makes it very good for me. Second, understand the power of compounding. It is easy to say, oh, we studied power of compounding in class 7. Unfortunately or fortunately, in class 7 you were not given the right examples. You were told, oh, if you had bought a ball of gold and this would be worth so much, it would be size of the earth, or things like that. It doesn't really matter, right? So how does it help? Over 400 years compounding, 300 years compounding, I still think go and see how much compounding would have happened over 30 years, 40 years, 100 years, 200 years. That is just to show the power of N. It is not that you buy something today and 200 years later your family is going to sell. I wish we create such heirlooms. I do not know whether we will be able to, right? But assuming you can, then you will understand the power of N. So go use the compounding formula and see how much the money grows. Money invested for 100 years, for 150 years, 200 years and 300 years. Completely theoretical concept, but understand this and make sure that your family understands this. Make sure that your children understand this. Make sure that your husband understands this, right? This is very important, because everybody says, oh, I understand compounding, but those who understand compounding should start a small SIP, 5,000 rupees, 1,000 rupees, whatever is your capacity. Only then compounding will have an impact. I know many investment advisors who did not understand the power of compounding. They were sitting there and they just benefited by the power of compounding, and now they know what power of compounding can do, right? So luckily for me, because of my teaching, I was showing this power of compounding through graphs and charts, etc. So I understood, and I had dividend income. So for me, compounding worked. So finding a buddy, then finding a good understanding the impact of compounding. To me, that is more important than even understanding what is the investments, right? Third is to understand how to read balance sheets, understand what is return on capital employed, return on net worth, right? Understand those words, free cash flow, understand those words, see how it works. Today it is possible for you to go to the website and find the calls which they did with other investors, right? So if there has been an investment call, that will also be put there and you will be able to listen to it. And then you will have analysts asking questions, and you also realize, oh, was I supposed to ask such questions? You will be able to follow it. Once upon a time it was not available. None of this was available, right? You have to be an institutional investor to get invited to a CFO's office to hear about all those things, and then you could ask, ye quarter kaisa lagta hai, or some shitty question like that, right? So learn and understand all these basic concepts. They are very important for you, because only when you know that will you be able to build your portfolio. And here I am not talking of building a dividend portfolio or a growth portfolio. Any portfolio building, this process will have to be followed. Another thing to remember is over the past 200 years, for which US has history, equity returns have been far superior to real estate or bonds, right? So this would be at 6%. I'm talking of the US market, and it will be 1% for real estate. There is absolutely no comparison. So similar thing has happened even in most other countries, including India, from 1979 when the Sensex was 100. Today it is about 95,000. I'm talking of the total return index, the TRI. So your money has grown 950 times. There is no way how the money would have grown at this pace in real estate or in bonds. What happens in real estate is occasionally you may hear a story that my father bought for such a price and sold it at this price, but still 100 to 950, 100 to 995,000, which is 950 times, is extremely rare, and you have to be extremely lucky because you did not even require partial liquidity. You bought a piece of land and you held it for 43 years, right? That's very difficult for anybody to imagine, unless it was a family property, it was in dispute, people were not willing to come onto the table. With equities advantages, or with an index, the advantages, you can get partial liquidity. You need money, you can get. You want to add money, you can keep adding money. You can do SIP, right? Those kind of advantages. So this is what has happened. So equity has given good returns over the last 200 years in the US and over the last 40-45 years in India. No doubt about that. Maybe even longer. I'm just talking from the day the index is available. Is that good news or bad news? Well, it is mixed news, because we are taking too much data from one country in the world. There are 138 other countries, and this country has been able to dominate. There was a time when they could tell you that if you want to build Hirakud Dam, United Nations will help you, World Bank will help you, but you have to buy cement from us. That kind of datagiri they've always been doing. So American companies have always dominated the world. They've done right, bad, good, ugly. They've thrown out dictators, they've brought in dictators, they've done all kinds of things to reach where they have. So whether any other country will be able to do all that over the next 200 years, I have no clue. But as of now, the evidence is equity will do well over long periods of time. So based on that, we will continue to do our SIPs, and we hope that the no Greece-like incident or a Japan-like 30-40 years of no increase in the Nikkei should not happen, or there should not be such a steep fall that it takes 30 years to recover. So assuming other things don't go wrong, or other things remain as it is, the chances are you will compound well with equity, right? Another very important principle to know is trading is very different from investing. So when you invest, you don't have to worry too much about brokerage, but if you keep trading in your portfolio, then you will not really seeing the power of compounding. You cannot dig a tree every day to see whether the roots have developed, right? That's what we do. Many of us do. We look at our portfolio and say, oh my God, ye to chal hi nahi raha hai. We need to sell this. 6 months have happened and the share is not going anywhere. But well, in 6 months nothing has happened, but in the next 1 month it can go up 6 times. Nothing stops you. So equity does that. Equity has decades of nothing happening, then in 1 week a full decade happens, right? So you need to know when to sit patiently, when to sell, when to cut your losses, right? So you have to have your stop loss. But remember that investment strategies have to be very different from trading strategies, and that one very important thing is activity actually increases your losses. It does not increase your it hurts the power of compounding. You pay more taxes, you pay more GST, you pay brokerage, so all those costs come to hurt you. Even if that hurt is just 1%, just imagine what that 1% can do to you over a 40-50 year period. Because assuming you're 22 years of age and you're starting now and you die at 102, then you're talking of 80 years of compounding, which has happened for people like Buffett. And so the question is, do you want to do more trading and more activity? Answer is no, you don't want to do more trading, more activity. You have to do less of trading and activity. Also remember that equity is like a partnership. I am in partnership with TCS to create wealth, and therefore they will create wealth, they'll pay taxes and give back my money, right? And that could be in the form of dividends, it could be in the form of buyback or whatever. So they are sharing. So it's a business. So largely businesses will do better than people who lend money to business. So if you are lending money to a company, then you will get 7, 8, 10, 12%, whatever is the prevailing rate, then that's all you will get. There is no upside to your debt instruments. In the real estate, what happens is if some place gets unaffordably high, people just shift to a different location. Today, geography is history, right? It doesn't really matter where you sit and work. I know a friend who had an office in Bombay and with very young employees, and they were all very happy to shift the office to Goa. So now they are operating from Goa, right? So these things will keep happening. So real estate may not give great return because tastes may change, people, and you don't have partial liquidity. That's another big disadvantage. So let's say today you buy a 4 crore property and you want 25 lakhs out of it. You can't get it. Of course, you can go and put it in the bank and borrow money against that, but that's a longish, cumbersome process. Whereas if you had 4 crores in mutual funds, you could just sell off 10 lakhs and you let the other 3.9 crore compound. A caveat here, when you require money for a short period of time, it's better to borrow from a bank at a reasonably high rate because you need it only for a month or two. You don't have to break your mutual fund or your equity because you will end up paying short-term capital gains, assuming, or in a worst case scenario, you may end up paying some load, right? Because you just invested in equity funds, now you need money. It may make sense to take those units to your banker, pledge it and borrow against that, or just take an OD or whatever, and after the money is after the work is done and you have the surplus, just pay it back. Paying interest for 2 months is better than impacting the compounding, because you'll just get into a bad habit of saying aaj nahi kal, oh the net is down, CVL has a problem, the KRA is not working, whatever be the reason. So so that indiscipline comes in. So better to be disciplined, say okay, I need 10,000 rupees, I'll go borrow 10,000 and I'll repay 10,000 after 2 months, because then in absolute terms the interest rate is not going to be very high. So you look at it and say, oh my god, they're charging me 14%, they're charging me 15%. Yes, but you're borrowing it only for 2 months, right? So then it might make more sense to borrow rather than sell and pay taxes. Diversification is a very important principle. So anybody who says that they don't have a diversified portfolio means he's the proprietor. So you don't go and tell an Azim Premji, why don't you sell some Wipro and buy Reliance, it is doing very well. Or you don't go and tell Mr. Mukesh Ambani, look, Adani's shares are doing better than yours. So for them, concentration risk will always be there and they will concentrate their portfolio. But as long as you are an employee, or you are not really the owner of the business, you are only an investor, then it is necessary for you to have a diversified portfolio. So diversification is very important. Don't concentrate all your assets, and each thing works for different people. So if you are an employee and you are getting ESOP and 80% of your portfolio is with your employer, that is again a very poor diversification. You are not the owner, so you don't know what is really happening in the company. You have to reduce your risk. Yes, it is possible that your share which you hold may do better than the other shares, but it doesn't really matter, because you have to provide for a Satyam kind of an incident, or where your money gets completely wiped out. So you cannot afford to take that kind of a risk. So understand the diversification into, say, PSUs, into MNCs, into commodities, into BFSI, right? All that diversification is very important, and enough number of people will tell you that diversification is the only true free lunch, and not get carried away by behavioral mistakes of saying, oh, I think IT is not going to do well for 2 years, this is the time of pharma. What if you are wrong? That is a question which I keep asking myself. What if I am wrong? So I will never go to 0 TCS, 0 Infosys, 0 HCL, 0 Wipro. I will never go. I will go up and down in quantity, but I will never go to 0, because I don't know in the short run what will happen. But I know in the long run these companies will generate money. They will do something sensible with the money, right? So retained earnings do compound, like I said. So be careful about what you are doing, and be informed about what you are doing. Understand it's a partnership, so it will work, but understand whether the underlying business itself is doing well or not doing well, or are they paying you dividends out of past profits. Those are very good signals for you to pick up and say, okay, let me be careful. But it doesn't mean you have to go to 0 holding in that. You could pare down your holdings, or you could increase your holding depending on your view of the market over the next 2-3 quarters. This should have been point number 2 or 1. Maintain an investment diary. That is very important, and I've seen very many people maintaining an investment diary where you write down by hand, or you put it in a Word document and saying why you're doing what you're doing. right? So that also helps in the long run to introspect and to know that you got something right by luck and not by effort. So this diary has to be something very personal, where you admit all your mistakes of how I lost clients, or how I lost money in the market, or how my client did not listen to me but benefited, or how my client listened to me and lost, right? So all those things would get recorded somewhere, whether it's your personal investment journey or whether it is your investment journey along with your client. So look at all that, maybe maintain 2 diaries saying this is what I will do in my personal life in terms of investing, and this is what I will do in my professional life, where I want feedback from customers, feedback from the market, with saying whether what I'm doing is right or wrong. All that is important. So writing down, diarying it makes a lot of sense. I think I've covered everything, so thank you.